I know you guys clicked on this video because you're probably struggling, you have no idea where to start, and you just want one video that is going to teach you everything you need to know on how to actually become a profitable day trader. And my goal for this video is to make this better than any of your favorite gurus, mentorships, or courses. It's just all in one video. So I'm going to be covering everything: setting up your brokerage, what are options, my entire breakout strategy, risk management, the psychology tips and hacks that I've used. We're going over everything. Now, if you want to start off day trading on the right track, this is your video. Enjoy. Okay, so first things first is, what do I trade and why do I trade that? Now, I trade options, which is a little bit different than trading equity, which is aka just the stock itself, because options give you the ability to buy 100 shares of a certain company. Now, I never let that expire, which means that I never exercise those contracts to buy the 100 shares. A lot of people get that confused when they're buying contracts. They think that they need to buy the 100 shares. Just think of it as a leveraged way to trade the equity. So for example, if a stock moves 5% in the day, a lot of people think that that is the most amount of money that you can make on an upside move. The reason why I trade options is because we basically have leverage of 100 shares per contract, which means this 5% is going to be a lot bigger because we're actually trading 100 shares of that for a specific price. So if we are basically leveraging the stock itself, a 5% move on a stock, depending on what stock and how much these contracts are, could be like 500%. Right? It literally depends on what the price of the actual option is. So, for example, today I took a trade and these contracts cost around $500. So every contract gave me the leverage to have 100 shares per contract. So every contract, think of it like this, right? There's a contract here, and this allows me to control 100 shares for a certain price. So I was able to pay $500 for this contract. And these contracts, I can 100 shares, it was on QQQ, times that by 600, that's exactly how much leverage I'm able to have for a price of $500. This is around $60,000 for 500. So even though the stock only moved, let's say, 1%, I was able to make 23% off of that little move, whereas I would only been able to make 1% if I was trading equity. So 60,000 to 500, that's exactly why I trade the way that I trade. It's the most profitable way to trade, and it's the most lucrative because this is what moves a lot. Now, a lot of misconceptions and myths are out there saying that you could lose a lot of money fast. Now, that is true, but you could lose a lot of money on anything. That's why risk management is a factor and it's a thing, right? Risk management exists for a reason. And I'm living proof that the way that we trade, I take on average around a negative 5% stop loss to make around 15% in a couple minutes. And that's literally what I'm going to show you guys today. Now, some other myths is you need $25,000 in order to actually trade options or to trade it more than 3 times in a week. And that's simply false. Now, the reason why people say $25,000 is something called PDT. Now, that basically means that you'll have a margin account, you'll have leverage, and if you don't have $25,000 in your account, you can only trade 3 times per week out of a 5-day rolling period. And yes, that's true, but that is not the only way that we could trade. Something called a cash account, we could actually trade an unlimited amount of times with our settled funds. So for example, if I have $5,000 and each position size is $1,000, I'm able to trade that 5 times for the day, and then it will settle by tomorrow, and then I'll be able to trade that exact amount of money again tomorrow. So let's say I made $500 today, and then we have a total account size of $5,500. That amount of money will settle by tomorrow, and then we'll be able to use that money tomorrow. Now, if I had a position size of $5,500, then I would only be able to take 1 trade. So cash account is definitely the way to go because not only are you using your own money, but you're able to trade an unlimited amount of times with your settled funds. So after we get that out of the way, the next thing is people think this is gambling. Now, I don't care what you want to call it. I'm risking 5% to make 15%, which is a 1 to 3 risk to reward, which means that I only need around a 30% win rate to be profitable. If you think it's gambling, I really don't care what you want to call it. This is a very lucrative thing that we could do to make money. It's all based on stats. And the way that I trade is based off what the market's telling me to take. And I'm going to show you guys later in this course. But you can tell that it's not gambling because there's so many factors that go into our entries that we don't just take a trade wherever. We don't just exit wherever. Everything is systematic. There's a whole plan here. If you think it's gambling, then everything in life is gambling. You go into your car, there's a certain percent chance that you might die, right? You take a plane ride to somewhere, there's a certain percent chance you might die. Same thing with trading. There's a certain percent chance that you're going to lose money, and there's a certain percent chance that you're going to make money on every single trade. So gambling to me would be something that I have no idea what I'm doing and I just enter without any parameters. Like, for example, if I play blackjack, there is an EV, which is an expected value, that I am gonna lose, right? I have a negative expectance value. So every time I play a blackjack hand, overall, on average, your P&L is gonna look like that. Unless you count cards or do whatever, but you barely are profitable with that. With this, we have an expectant value of around 0.8, which is extremely good. And I'm gonna go more into that later in this video, but that is extremely good, right? Expectant value of 0.8, which means that every single trade that I take, on average, I will make 0.8, which means that my P&L chart is gonna look like this, which is amazing. So now that we got all of those myths out the way, I'm gonna go over exactly how I trade. Now there's 3 different types of ways that you guys could trade that I'm gonna label is swing trading, day trading, and scalp trading. Now, the way that I trade is scalp trading. The reason being is because I want to know if I'm wrong almost immediately. I don't want to be in a trade for 1 hour or 2 hours and know that I'm wrong in an hour, right? Be in this trade for an hour and then it ends up selling me on my stop loss. I don't care for that. Number 1. Number 2, day trading, you get a risk to reward around 1 to 2, 1 to 3 maybe, and it takes an hour or 2 hours to really play out. Now, some people like that, some people don't. I personally don't. I can get a 1 to 3 risk reward in a couple minutes with scalp trading and have a very high win rate. So, okay, we're going to have the same metrics here, 1 to 2 risk reward, 1 to 3 risk reward, but if we get a 1 to 3 risk reward in way less time, 2 minutes, 3 minutes, then why would I not do this? And then swing trading, some people's lives, they have to swing trade because they don't have time for scalp trading, because swing trading, you could just enter wherever in that certain area. This is going to take, let's say, 3 to 4 days to really play out. And you still get that 1 to 2, 1 to 3 risk reward. And you're not going to know you're wrong until a couple of days later, or maybe that same day. But either way, for scalp trading, we know we're wrong almost immediately. This takes 2 to 3 minutes per trade. Obviously, we're sitting there waiting for it to hit. And then once our key level, which I'm going to go over in a bit, once that parameter is hit, that's when we enter. And that gets us a 1 to 3 risk reward in a couple minutes. Why would we not want to scalp trade? So that's why the way that I trade, I think it's the most lucrative way to trade. I don't trade ICT or none of that. I scalp trade, and I think scalp trading is one of the best things you can do. Obviously, I'm going to find the best way to trade, and that makes me the most profits in the least amount of time with the least amount of risk. And scalp trading, it can get me a 1 to 3 risk reward in a couple minutes. Why would I not want to do that? I think it's crazy to trade any other way, but that's just me. Now, you guys have probably seen this before, and you guys have seen the candlesticks on a chart. So how exactly do we read this? Now, first off, there's different types of candles, right? There is the Hikinashi candles. There's these regular candles. There is line charts. There is bar charts. There's footprint charts. There's so many out there. There is no reason to complicate it at all. What I use is just regular candlesticks so I can see what the price action is doing in real time without all that extra indicators or the lagging stuff. Like Hikinashi, I don't really care for it. This allows me to see exactly what is going on in the market, as well as a couple other things that I'm going to talk about later in this video. But we're just going to really understand how to read these candles. Now, for these green candles, as you guys can see, the way that these are structured is wherever we open up at, this is where it's going to start the body. The body is this section right here. And every candle tells a story. Not only after the candle closes, but during the candle. As the candle is moving, it tells us a story and we have to read it. Just like you can't judge a book by its cover, same thing here with these candles. That's why we have these wicks right here, which they're called wicks. As you guys know, it's a candle and then a wick. And they also allow us to read the story of the market. So for a bullish candle, which gives us a green candle, we open up here and we have to close higher than what we opened at in order for it to be a bullish candle, in order for the candle to be green. And then this is where we closed at. But as you guys can see, there's more information here. There's wicks. And what the wicks are telling us is exactly where price was able to go, the high and low of that area, whatever time frame these candles are. And that gives us some context clues. So for example, let's say we opened up here and then we started to be red. We came to this low right here. And then we came all the way back up, made this high, and then we came all the way back down right here. We're kind of stagnant in that area. We did have a nice body of the candle right here, but we have these two wicks, which means that we came all the way down, came all the way back up, came all the way up here, and then sellers were able to bring it all the way back down to here. So we have some resistance up here and we have some support down here because these sellers were just stopped at this low and then we bounced right back up, which shows that we are pretty strong. Now, the stronger the candle, the less wicks are going to be at the top end right here. So for example, since look how big this wick is, if this candle body was all the way up here and we had no wicks, that shows us that it's a little bit stronger. Also, for this, for example, if this was a little bit longer, that showed us that sellers tried to bring it all the way down and then buyers were able to bring this from here all the way up there, which shows strength. That's why it's very important to read what the market is telling you to do. Now, for this, it's literally the opposite. We opened up here and we were able to close all the way down here, which gives us this bearish candlestick, which gives us this red candle. Now, we had a high all the way up here, and then we were able to come all the way down to this low, and then buyers are bringing it up a little bit, and then we closed here, which means that we had some support down here, and we had some resistance up there. These candles, they're moving a little bit, right? They're moving the market. They're not as strong as they could be. If this candle was able to close all the way down here, that would allow us to note in our head, okay, this is a pretty strong candle to the downside, because there's no buying support here, right? There's no support, and these sellers just absolutely killed them at the top when it was green, and then it came all the way down. So that's the leading indicator of these candlesticks are the wicks and just how big these bodies are. Now, let me show you guys another example. So let's say we had a candle body like this, and let's say that's green. This is a pretty strong candle because we had a decent sized wick right here, right? Sellers were able to bring it all the way down here, and then buyers ate this all up and brought them right back up and closed pretty strong because there was no resistance to the upside because there's no wick. Same thing with the downside. If we come down and then we had the wick right here, that means buyers brought it up and the sellers absolutely killed them down there all the way down to here, and then we closed full. No wicks there, which means that there was no buying that was happening, but you also have to watch it real time because it literally could just fall back and forth, and then finally close right there. So that's what you got to be careful for. But if we just saw a candle like this, pretty weak candle. Now, it would be weaker if we opened there and then closed there, and it just literally fell the entire time, right? That's a pretty weak candle. But we're going to go over more about price action, which is exactly the candle structure, in a bit. Now, I want to go over what option contracts are. What exactly are option contracts? So what you guys see in front of you are something called option chains. Basically, these are all the contracts that we could pick. There's a lot more, but these are also just the contracts that I am going to be looking at, which I'm going to go over in a second, but there's tons of contracts. This area right here is something called at the money, which basically means The stock price is right in between this area right here at the money contracts. Now, since you guys can see 670 and 669, the price is somewhere between this area just because we are at the money. So whatever is in this area, that's where the price is at, because you guys can see the two different colors. We are in the middle of this area. Now, this side is going to be calls, and this side is puts. And what does that mean? So if we take a call, just like I was talking about earlier, we are longing the stock. So the contract states that we are actually buying 100 shares of the underlying stock, which means that we want it to go up, right? If we take a call, we want this to go up. Now puts, we're actually shorting the stock, and we have 100 shares, or technically negative 100 shares of that certain stock, and we just pay a premium, let's say $500, to short 100 shares. So we can make money if it goes up, and we can make money if it goes down. This puts is just shorting the stock with leverage, and calls is just longing the stock with leverage. Now, at the money, there's two other terms. This is going to be in the money, and this is going to be out the money. That basically means out the money, we haven't got to that area yet. So for puts, anything below 670 in this example, we haven't got there yet, right? So which means that there's a very high chance that they're going to expire worthless, which is why you guys can see zeros, ones, zeros. These are very cheap. Now, in the money basically means that we've already passed that area, and this has a chance to expire with some value. So as you guys can see down here, 841, 1066, 841. This is actually $840 per contract. This is $1,066. So whenever you guys see like 0.72, that's $72 per contract, as you guys can see right here. And that's basically how much these contracts are. And you guys can see right here, this is the bid, this is the last, and this is the ask. This is the day that it expires. So a lot of times I like to do 0 DTE, which means that expires same day, which means those contracts are going to move a lot more because it's closer to expiration, because it could expire worthless, or it could expire in the money, which means that we're able to actually exercise these contracts, which means that it's not going to expire worthless. So it's going to have some value towards it, especially the further in the money you go, which is why these are $800, these are $1,000, and these are zero, because from where we're at right now, at the money, it has a very low chance of coming up $10 by the time that it's supposed to expire, which is 4:15, depending on what contract you're taking, 4:15 p.m. Eastern or 4 o'clock Eastern. And if it doesn't reach that strike by then, it's going to expire worthless. And since I think we're like 5 minutes away from the market closing, this is why they're at zeros, because there's a very, 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 very low chance that it's going to go to 680. And even right here, right, we're at 669. There's a very low chance it's going to hit 670 in 5 minutes. And same thing with the puts right here. There's a very, very, very low chance that we get under 669, which is why it's only $2 or $7. And then in the money, as you guys see, $200, $300, because there's a really good chance that we're going to stay under 672 in the next 5 minutes. So how exactly do I pick the contracts? Now, I like to look for the most volume in a certain area. What you guys see in front of me is volume and delta. Delta just means that for every dollar move, this is how much these contracts are going to add in value. So every dollar move, let's say we're at 420 and the delta is 0.5, we'll be able to add $50 every dollar move. So if we get to 421, the contracts will add $50, which could be 50%, depending on how much the options actually are. Now, why is this important? Because we're taking the best, leaving the rest contracts. I usually go for at the money contracts, maybe 1 or 2 in the money, out the money. So anything that's under 0.4 to anything that's around 0.4 to 0.6 delta is what I look for, because I want to get around $40 to $60 per dollar move. So we get rid of this, all of these, we get rid of all this, and we also get rid of all these. Get rid of all this on this side as well. And then we're left with around 6 contracts. Now, we're also going to do it in the out the money as well. And we are going to remove all of this. As you guys see, it's above 0.62. Now, the next thing I'm looking for is volume. So I want to find the most volume in this area right here, around 4 or 5 contracts that we have left. 102,000, 50,000, 30,000, 13,000. So this is obviously a winner right here because it has 100,000 volume. And these are the 420s. So if I'm going to play an upside move, I'm going to take the 420 calls because this has the most volume. It's in the 0.4 to 0.6 delta. And that's when I'm able to enter. Now, if you think it's confusing, it's really not, because I'm not taking 0.5s. So you guys see that it says 422.5. I am not taking these contracts. They statistically have way less volume, so it's easy, right? I don't take those. I don't take those. And it just leaves us with a couple. Now, if we're going to take a 420 to the upside, we'll probably end up taking 420 calls. So I can find contracts in 2 seconds because all I see is, okay, we're about to take this 420 break. Let me see how the 420s are. Okay, they have 100,000 volume, 30,000, 50,000, 13. All right, boom. I'm going to take the 420 calls to the upside and closest expiration. It's the most simplest thing, but you're probably going to overcomplicate it at first because it's a new thing, which totally makes sense. Now, how do the delta actually increase in value? Because as you guys can see, we're in the 40s, 50s, 60s, 70s. It's something called gamma. Now, every dollar move, gamma adds to the delta. So if we're at a 0.5 delta, and let's say gamma is at 0.05, for every dollar move, let's say we go from 420 to 421, now the delta is going to be 0.55. So now every dollar move, we're going to make 0.55 on the underlying. And that's how we're able to get this delta all the way up to 80. And then same thing here. We're able to get it to 80. And this is how we lose more money, is we're going to lose the $50. And then we're going to lose $5 off of that delta. So the next dollar move, we're only going to lose $45. And it's going to keep going lower and lower and lower. But these contracts are going to get absolutely cooked. So that's why we're waiting for the best, leaving the rest. And we have to get the appropriate contracts, because if we get too low of a delta, we're kind of going to be screwed there because it's not going to move as much. And if we get too high of a delta, they can come right back down if we start falling. So that's why I get at the money contracts. They have the best risk to reward. They're the least riskiest, in my opinion, based off how we trade. And I'll lose, again, negative 5% to make 15%. And a lot of people think that's impossible with the 0DTE. Me and my students do that every single day, right? It's just what you think about. It's just your perspective. And if you think something's impossible, then you're always going to think it's impossible until you actually do it. Same thing with that 4-minute mile. People thought they weren't able to get a 4-minute mile until they actually were able to, and then everyone started hitting a 4-minute mile. Same thing with this, right? I'm living proof that it works. So is my students. So now I want to go over what exactly is on my screen right now. So I talked about earlier with the candlesticks themselves, and you guys know what candlesticks are. You guys have seen there's a bunch of candlesticks. Now, time frames are really important. The time frame is the 1 minute time frame, which basically means that every candle is 1 minute worth of data. So in this entire candle right here, it is 1 minute of price action. Price action just means what we're doing in that area, what price is doing in that area. And this is just 1 minute's worth of price action. Now, the higher time frame we go, the less candles you'll see, but the more data we'll have in one candle. This is 5 minutes of price action. This is 5 minutes of price action. This is 5 minutes of price action. This is 5 minutes of price action, right? This is all 5 minutes each of price action. And we continue to go higher and higher and higher. This is 1 hour of price action. This is 1 hour of price action. This is 1 hour. This is 1 hour. You guys get the deal. And we have all of these time frames here. So what time frames do I use? Well, each time frame is going to be depending on what I'm trying to get out of the market. So for example, when I make my key levels, which I'm going to go over in a couple minutes, I use the 1 hour time frame. The reason being is because if we take a look at the 1 minute time frame, there's a bunch of noise. As you guys can see, look at all of these candles, right? It's just too much going on for me to have a solid level. The 1 hour time frame though eliminates all that noise by having these candles be a full 1 hour of price action. So we're able to eliminate a lot of noise and we're able to make the best key levels, which is basically where I enter the trades at. So that's why I use the 1 hour. Now it helps give direction and it also helps to make my key levels. But the 1 minute is super important as well because this is where we enter. I'm able to see real time what the buyers and sellers are doing. And it's also something I use, which I'm going to go over later in this video, something called time of sales. But this price action, right, it's just not all over the place. There's actual structure here. And this is something that allows us to take the trades intraday, which basically means on the 1 minute time frame, and allows us to get a 1 to 3 risk to reward in a couple minutes. Now, some people are so against the 1 minute time frame because they think it's a lot of noise. They just don't know how to fully read it, and they think it's too much. It's not, right? If you know how to read candlesticks and you know what to look for, the 1 minute is not a bunch of noise. That's why we use the 1 hour time frame for key levels, and we use the 1 minute to execute our trades off of. The market opens every day at 9:30. There's a specific window that I take trades at. I only take trades from market open to around 11 o'clock. The reason being is because based off my data, number one, from 9:30 to 11 o'clock has the most volatility in the day. Statistically, that's a fact. Number two, if I trade after 11 o'clock, my win rate and my risk reward drop. There's not as big of a volatile move, which basically means that we're not going to be able to get the 1-3 risk reward as fast as we can in the 9:30 to 11 o'clock. And you're just overall, all the stats start to drop after 11. The moves don't really happen like that anymore. We start to consolidate and it's just too random for me to trade. So I only trade from 9:30 to 11 o'clock. That's it. So I only trade from here up into here. And if we're able to get a move during that time, great. If we don't, then I just wait for the next day. That's it. I'm taking the best, leaving the rest. But we usually are able to get a couple moves during the day. For example, today I took QQQ, and we took this to the upside right here. And we can go over the trade real quick so you guys can just get an understanding of exactly how I trade. I took the trade off of the 600 level. We got in right around here. My stop loss is going to be the open of this, or the low, like right there, is basically the same thing there. And my full out was at 601, which, as you guys can see, this is way higher than a 1 to 3 risk to reward. And I was literally risking 5%. And I would probably lost like 3% to make 23%. I sold right at this high because I was waiting for that 601 break. I was selling some on the way. 23%, risking around 3 to 5%. That is way higher than a 1 to 3 risk reward, which is great. My full ROI was a 1 to 3 risk reward because I was risking 5K to make 15K. A 1 to 3 risk reward in 1, 2, 3, 4 minutes. And you might be like, oh, it's only 3% or 5% and 23%. Listen, those people that are hitting 100%ers, this and that, our stats are way better than them because that's not a sustainable way of trading because they take a lot of losses. Their full ROI is not 100%. That's the most important thing. Let's say you had a $1,000 position size. You would have risked $30 or $50 to make $150. That is so scalable. Your P&L chart's going to look like this, right? If you had a 50% win rate, because it's 3R, and you lose 1R, plus 3R, lose 1R. So it's just way more sustainable that way, and it just happens in a couple minutes. Now, going over the candlesticks, you guys can see that this is a pretty strong candle coming into this pocket right here. Now, I'm going to go over this price action in a bit, but right now I just want you guys to focus on the candles. We opened up here, the lowest we got was down here, and then we were able to flip this, and we closed pretty strong. Then sellers came down a little bit, and then buyers brought it right back up. We got a little wick right there, which is fine because we're at this high of day where we were rejecting previously. And this is just common because this is a huge wall in that area. The reason why I wanted to trade that 600 break, as you guys see, this is a 600 break, was because there's a huge wall there. I'm expecting some resistance there. As you guys can see, we rejected that previously in the day. And sellers brought it right back down, came all the way back up, touched this 600 level, and then we opened up here, no wick, right? It's a very, very small wick, and buyers were able to really push this thing. Now, price action alone wasn't the reason why I was able to take this trade. It was also time of sales. Now, let me bring up the trade that we took today. So I was trading this live. This is on my second channel. This is where I post all my trades. And you guys can see this numbers on the right side of my screen. I'm going to go over that in a bit, but I want you guys to remember this. So watch this trade play out.
It's about to break 99s. Like that.
So we're having that breakout. My stop loss is going to be right here.
Stop loss is going to be this low, this previous candle. Contract at like 4%, 5. Just got to keep going for me to be able to start taking some off.
And then watch, it literally just keeps going. No drawdown there at all. Had a little pullback right here. And this is what I'm targeting, that 601. Took some off along the way.
601. Bro, we break 601, I'm going to be fully out. Alright, you got to break by more than 1%.
Waiting for this to break.
There we go. All out right there.
Sold right there. And as you guys can see, the Discord.
Shit out of that W button. Great start to the week.
Killing it, right? Chat is killing it.
Bro,
there was a couple factors that went into me actually taking that trade. Now, the first thing was we found this 600 level on the 1 hour time frame. So we went into the time frame of the 1 hour and we saw what reacted. So this isn't going to be as clean of a key level, but we had an intraday reaction. So for this example, we're on the 1 hour time frame and we see a couple reactions in this area. We can see that we bounced off of that and then we broke under. We kind of rejected that area. We kind of stood in that area. So we rejected. It's not as clean of a key level, but what made this a nice key level is because we reacted intraday right there at 600. 600, 700, 800, those are very strong psychological levels. Now, we reacted intraday, which made me interested in that 600 level. We also had a huge wall there on the level 2. So that's what made me interested. Now, for a nice key level example, let me bring up Tesla. Now, this 380 to the downside is a pretty strong key level because we had a couple reactions here. We came all the way down and then we just stopped right at that 380. We came all the way down and then we stopped at around that 380 area. Now, the reason why we stopped, and this is why I want to see price action kind of chilling there and reacting at a certain area, is because think of it like a dam. The water is getting stopped at this dam because there's a strong wall. All this water is getting stopped at this dam. Now, what happens when the dam breaks? Well, in order for the dam to break, we need enough buyers or sellers, aka the water, in order to break the wall. So we need a big enough pressure of water to break this dam. And when the dam breaks, guess what happens, right? It doesn't just slowly leak out. If this dam was able to break, then that means we need enough water pressure in order to break that. That water pressure has to go somewhere, and it's absolutely going to go crazy after it breaks, which is why you guys just saw that breakout. When it broke 600, it just flew a little bit like that. That's why they fly, because once that wall breaks, in order to break the wall, we need enough buyers in that area. It's going to absolutely fly. So that's why price action kind of stops there. And that's why I want to see reactions, because this is a wall. This is a dam, and water keeps bouncing off of that. It's not strong enough to break, but in order for us to be able to tell how strong of a wall it is, we're going to look at the level 2. And then we're also going to see real time and sales. So those numbers that you saw on the right side of my screen, that's exactly how I'm able to see real time what the buyers and sellers are doing in order to gauge if we're actually going to be able to break the wall or if it's just going to be a fake out, which basically means it breaks the wall and it comes right back up. Because if a dam breaks in real life, the water's not going to break it and then come right back up. I want to make sure that the wall is actually broken and it's going to continue to the upside, which is why we use the time and sales. So let's go over another example of key levels. Let's take a look in the video. And as you guys can see right here, this 212 area, no candle body has broken over this 212, right? We broke it by like 20 cents right here, which is fine because we'll be able to take this 212 into this high. But you can see that no candle body is closed above that. We reacted at the 212 area. We reacted at the 212 area. So when we do come up, I want to be able to take this 212 to the upside because we're seeing reactions in this area. But that leads me into intraday levels is we come back to the 1 minute time frame. We go to QQQ. And I want to make sure that we react in that area because if we react in a 1 hour time frame, that allows me to be able to look to see, okay, this is a potential key level here. But if we get a reaction intraday, which basically means on the 1 minute time frame, that actually validates the level even further because now the 1 minute is actually reacting at that 600 level for this example. And we'll be able to take this to the upside if price action is looking great enough, which means that these buyers are actually not going back and forth. If a level was right here, this would be too choppy, which basically means that there's no actual direction there. And that's why we're able to take the 600 because we were able to break out of this little zone with aggression. And we were able to gauge that based off the time of sales and how the price action was actually moving. Now, let's go over what brokerage to use first. Before we could take a trade, we need to have a brokerage. A brokerage is basically just an account that we put money in that allows us to trade. So there's a couple brokerages out there. There is Thinkorswim, aka Schwab. There is Robinhood. There's Webull. There's Interactive Brokers. There is a bunch of them. There's Moomoo. The ones that I personally recommend is Thinkorswim, aka Schwab, and Interactive Brokers. Now, they have proven to give us the fastest fills, the best fills, and they're the most reliable. Now, some people might be like, okay, but they charge a commission. They do charge a commission, and that is for a good reason, right? So let's say, for example, the commission is around 60 cents. You could actually get that lowered if you have more volume. So if you're trading a lot of contracts, you can get this lowered all the way down to like 25 cents. But you would have to be doing a lot of contracts. You can get it down to probably 50 if you just ask nicely. Now, the reason why they charge us a commission is because these fills are so amazing. So let's say on average, our contract's commission is going to be 50 cents. So 50 cents there, 50 cents back. A total of $1. Which basically means that for every contract that we take, let's say the contracts are $500 a piece, we will give $1 of that to whatever brokerage. Now, people are enticed by free commission. They don't realize that the spread of the actual stock itself or the actual contract itself is their commission to Robinhood or to Webull, and that actually gives you a worse price contract. So, for example, since it's only $1, if the brokerage, let's say, buys the contract at 500 and then sells you it at 501, that's their commission right there. And let's say I get filled at 500 and you get filled at 501. That's $1 difference. I already paid that $1. I'm okay paying that $1 because I just got a better fill than you. I only need to get at most $1 better fill than you in order for that commission to be worth it. Because let's say Robinhood decides to fill you a little bit late and it fills you at 502 per contract and it fills me at $500 a contract. The brokerage that I use that I have to pay commission to, which is the $1, actually made me an extra $1 per contract because it got me a better fill. So even though you didn't pay no commission on a fill of 502 and I paid a commission of $1 at 500, my full price in is 501 a contract. You got filled at 502 a contract, but then you're boasting about not having any commissions, even though I just got a better fill. And then let's say on the sell, you get filled at 500 and then I get filled at 502 because I just have a better brokerage. That's a $2 difference. It's just profit there, right? So I just lost $1 for commission to have a $4 difference per contract in profit, which means that that dollar actually made me an extra $3 versus Robinhood and Webull, where they actually make money on the spreads. You lost a total of potentially $4 right there because you didn't want to pay the dollar commission because you like free commission. Nothing's ever free, right? There's no free lunch. This is why I tell people just use Thinkorswim, aka Schwab, or Interactive Brokers, because they're going to give you the best fills and the fastest fills like that. Anytime I ever test this with someone, they always have problems with Webull or Robinhood, and they have a worse price contract than I do. Something to also note is economic data. Now, there's a website called Econoday. We're going to come all the way down to here. Upcoming U.S. announcements, very important. And we can see the economic data that could be released for this week. Now, this says delayed because of the whole government shutdown, but I come on here every single morning and I see exactly what news is for the day. So, for example, for tomorrow, we can see that we have PPI announcement 8:30, so I don't really care about it because I'm not trading at 8:30 a.m. Retail sales, 8:30 as well, 9 o'clock, 9. Now, for this, we can see that it says 10 o'clock. That is something that I'm going to note. So my pre-market game plan, I'm going to note, okay, consumer confidence at 10 o'clock. We have business inventories at 10 o'clock. And then we have pending home sales at 10 o'clock. So basically, I need to either be almost fully out of my trade at 10 o'clock or just wait until after 10 o'clock for me to take another trade. I could take a trade before 10 o'clock, but I need to make sure that I'm not still freshly in a trade at 10 o'clock, or I'm not going to take a trade as 10 o'clock is about to hit. And this also could be the reason why the market's slow until 10 o'clock. So that's why I come on here, because if you get in a trade and then news drops like that, it could absolutely kill your contracts if it goes in the opposite direction, because this is what moves the market. So that's why I just write this all down. Now, the other thing is going to be earnings. Now, what I do for earnings is I go on here and I look up eWhispers on Twitter, and they've released this every week. And I basically just see what earnings there is for the week. Now, basically what I'm looking for is stocks that have relevance to me. So, for example, Tesla, Nvidia, BABA, anything that potentially I could trade that has a lot of volume, Disney, Meta, anything like that. Now, as you guys can see, there's barely anything here. Maybe BABA. I haven't traded BABA in a while because it's just been super slow. But this is what also could move the market, and this is also what we could watch out for, because let's say Nvidia has earnings after hours today, then Nvidia is going to be on high watch for tomorrow. So this is just something to look at in the beginning of the week to see what earnings we have for the week. But the economic calendar is very important, because I've seen a lot of people get wrecked because they don't realize news is there. Unless you're in the Discord, I'd say this every single morning, what news we have. But if you're in a trade and news drops, it could absolutely kill your contracts and your trade itself. So these are just something to note. And then we can see for the rest of the week, okay, GDP's on Wednesday. That could move the market as well. The market could be slow until then, so it's just something to note. And we also have news at 10, 9:45, and 10:30, so it's a lot. And we have to really be careful of that. Now, how do we place a trade? So for Thinkorswim, what we do is we go over to Active Trader. But before that, I want to set up this entire thing, right? So you guys, when you guys first download Thinkorswim, it's not going to look like this at all. Okay, so as you guys can see, this is exactly what you're going to see on your screen. So how are we going to set this up? Now, first off, we're going to go over to this icon right here. We're going to click that. And you guys see the overlap volume. We're just going to overlap that. And we want to make sure everything is here. I personally just choose to take this off because it's distraction when the orders are shown. And I also want to remove this, the show symbol. A lot of times there's a big symbol right here. It's super annoying. I got rid of that. And we move over to price axis. So this is fine. This is fine. Time axis. So display, we want to get rid of all of these. This just has the cleanest look to it. Make sure these all are unchecked. Appearance, we want to fill this in. We want to make the red white. Now, the reason why I do this is because it's a psychology thing. A lot of people, when you see red, you associate like bad. You guys have more of an emotional response when it comes to the color red, especially when it starts to come down. So this alleviates those emotions and allows us to have no emotions when it comes to the color red. This just helps. Like, why not? We come down to here. You see the background? Click that. We want black. Grid, we get rid of that. And then we hit apply. Also, I have a free community, the link in the description below. I host lessons once a week for you guys for completely free. The link is in the description below. And as well as if you guys want one-on-one help from me, the link in the description below as well for that. And let's get back into the video. Come over to equities. Show volume subgraph. Get rid of that. Hit apply. Hit OK. And now it looks like this. So if we go to the 1 minute time frame, we can see it looks like my chart. Now, that's basically it. For the active trader, right? So I'm going to set you guys up with Thinkorswim. You guys can see this little icon right here. There's 1, 2. Make this. Let's actually make this 3. Just for so you guys can mess around with this after. I'm going to type in QQQ. I'm going to type in QQQ. Now you might be like, okay, do I have to do this every single time for all these? No. You right click. You guys are going to go to style. And you guys are going to save style as, let's just say, the regular. Right click, style. And you guys are going to load style and regular. Load style. You guys are going to go to regular. Boom. Now, what we're going to do is we see all of these right here. We are going to unclick chart, click active trader. We're going to unclick chart and go to options chain. Now, you guys are going to see this link thing right here. We're going to make this 1. We're going to make this 1. And this one can be left blank. Now, anytime I switch ticker symbols, the option chain also follows with it. So for this, we're going to do Qs. We're going to go here. And we're going to have to mess around with this a little bit. So let's go to filter, expirations. We are going to do days expiration 0 to, let's say like 5 at most. There we go. So now we're just left with this. We're going to do strikes. We're going to do 10. Now for this, we are going to customize the columns. So I don't care about that. Care about that. We do last. Now, you guys can see the options chains here. We went over the options chain to use. Let's go to Tesla because this is expiring the same day. It already expired. Go there. We're going to right click. We are going to send to 2. Now, we're going to make this active trader 2 as well. So anytime we send it, it's going to send here. Send it, send here. So if I want to trade NVIDIA, this is going to move. We right click this. We hit send 2. And it goes right here. Now, for this, we're going to click this little button right here. We're going to hit auto send. We get to pick how many contracts we want to take. And then we just buy market, sell market. The reason why I market order is because the spreads are so small. It's super liquid contracts. So I'm able to get a really nice buy. So you market. That's it. And you can see the contracts on here. You can put a limit order on here if you want. But this is exactly how we set it up. We hit buy, auto send. And this is basically like what you need. Now you guys can set it up on your monitors. I also have the 1 minute time frame. I have the 5 minute time frame. I have the 1 hour time frame, and I also have the daily time frame. So I'm looking at all those time frames at once to see context. But now you guys can do what you guys need to do with this information right here. We basically set that up. So this is how we place a trade. Boom, just like that. So if I'm like, all right, watching Tesla, I'm going to be taking the 420 calls to the upside. We're going to go here, 420, right click this. We're going to send to 2, and then once the key level breaks with great price action, the time of sales, we're able to enter just like that. And these are going to be like the most liquid contracts in this area, as you guys can see, 102,000 versus 30, 50, 13, and delta of 0.4 to 0.6, just like that. So let's go over some drawing tools and key levels. So now if I want to, just go like this. Make sure you guys save this as well. If you guys go to your main screen, you guys can right click the top of your brokerage and hit save workspace as. So make sure you guys save this before you exit. So now just for this purpose of drawing, you guys can see the bottom right, you guys see this little icon right here. There's a bunch of tools. Now, trend line, this is what I have. This is what you guys are going to see. I'm going to right click this, edit properties, make this blue. Style, I like to do it this one, and save as default. Click that, right? You have a little trend line right there. You guys could also just make this trend line full. Just go like that, and you can make it like that. And if you want to save that, save as default, etc. We go back, we get rid of this, click it, hit delete. Now if we go to this rectangle right here, I like to make this color that color right there. I also like to hit more. HSV, transparency, I like to make it 65. Save as default, go like that. So anytime I make a rectangle, you can make it green as well. I always make it 65. And anytime I want to make a triangle like that, make sure you save as default. There it is. Right click, clear drawing set, clears everything. Then what I like to do for the Fibonacci, as you guys saw earlier, I did a risk to reward tool. So right now it's going to look like this. I'm going to right click this, edit properties. I am going to get rid of everything that is not a whole number. So 0, I'm going to make this 1, make this 2, make this 3, make this 4. So risk to reward 1, 2, 3, 4. And we're going to make this red. We're going to keep this, let's just say yellow, and then green, green, green. We are going to make this, we can make it green, that's fine. And hit OK. So right now it looks like this. So I'm going to right click again, and I'm going to save as default, hit OK. And now I'm just going to test it out real quick. Perfect, looks good. So delete this, delete this. So now we can see our risk to reward in real time. We go here. Let's say we are going to take 600 break on Qs like we did today. We go here. See this right here. We're going to click this. This is where it starts the Fibonacci. And then wherever our risk is at, we're going to put this right there. And a 1-to-1 risk reward is right there. 1 to 2, 1 to 3. What I like to do is I like to get rid of this. And I'm going to get rid of the 2. So there's 1 to 3, 1 to 4, 1 to 2, 1 to 3. We're going to hit OK, save as default, hit OK. Actually going to come back, right click this. I want to get rid of the numbers. So do not show. So right now, all we can see is these numbers. So this is a 1 to 2. This is a 1 to 3. This is my stop loss. Now let's say we were taking this to the downside. We get in here. Our risk is going to be right there. A 1 to 2, it's going to be right there. A 1 to 3 is going to be right there. So it's a pretty cool feature. I don't really use it a lot unless I'm showing you guys the risk to reward real time. But it's just something cool to have. So now for key levels, price level. See how it looks like that? Came here, right there, right click, make this blue. Style to here. And we're going to want the left extension on. Save as default, hit OK. There we go. And we also want to make sure that we also show price on the right. Save as default, boom. So anytime you make key levels, now it's going to look like this. All right, so now what you guys are looking at is a risk reward and win rate chart. So this is a little cheat sheet to show what is possible with profitability. Now, this basically tells you your win rate right here versus your average risk to reward and what is needed in order to be a profitable trader. So for a 1-to-1 risk to reward, which means let's say you risk $5 to make $5, in order for you to be profitable, you need a 60% win rate, technically a 51% win rate, and you're break even after a 50% win rate. Now, if we keep going down to a 1-to-3 risk to reward, we only need a 30% win rate to be profitable, which is pretty nice. On 1-to-2 risk to reward, you need around a 40% win rate to be profitable. I think it's around 37%, and so on. Now, the way that we trade, we have the highest profitability around a 1-to-3 risk to reward because our win rate is around a 80% win rate to hit a 1-to-3, and it drops significantly. It drops to around like 40% if we try and go for a 1-to-5 risk to reward. So based on my data, I'm more profitable at this 1-to-3 target right here. So that's why I really try and target that 1-to-3 risk to reward based off my data. Since we're profitable with a 30% win rate, that means that if we go to a 40, 50, 60% win rate plus, we're super profitable because with a 30% win rate, let's say we win one and then we lose, win one, lose, win one, lose, right? We're still getting some sort of profit factor there, some sort of profits there, and we're off of this break-even stage that a lot of people are at, and it's just math. Now, if we had a 50% win rate, one, lose one, nice winner, lose one, nice winner, lose one, right? And it's just really exploding and compounding because these drawdowns, these losses are so small compared to our winners that our winners are able to really compound because we're only taking such a small loss every single time. It's just basic math. Now, a lot of people, the reason why you break even is because you win and then you lose. You win, you lose. You win, you lose. And this is at a 50% win rate. At a 50% win rate, we're super profitable. As you guys can see, right? We're lifting off. You guys, up, down, up, down, up, down. So the first thing I do when people join the mentorship is I look at your journal and see what is the biggest ROI task that is needed in order for you to really lift off that ground, or the reason why you're not profitable right now. And it's usually the risk to reward or the win rate. And, you know, if their win rate is super low, we either need to fix the strategy or we need to fix, okay, you're just taking a lot of losses for absolutely no reason. And then if it's the risk to reward, it's probably because you guys are taking too big of a loss or too small of a winner. And then I kind of just break it down, figure that out. And in a week, their profitability starts to go in this area because I'm just breaking it down mathematically. It is all a math game. If you're break even, it's so easy. Like, it's insane. I just literally look at your journal. And the problem is a lot of people don't have a journal, so they don't know exactly what you need to fix. But that's the whole point of journaling, is to identify problems that needs fixing. And that's the next thing, just journaling. You guys need a journal. So now let's go over drawing zones and reaction areas. So for example, right here, let's get rid of this whole set. And let's go to drawing a zone. Now, the reason why I drew that today was because we had a lot of reactions in a certain consolidated area, which means just in this certain area right here, we had 1 reaction, 2 reaction, 3 reaction. Now, the reason why I didn't include this is because this didn't reach up to there, up to there, up to there. Where is the most reactions in a certain area? Right here, intraday. So what I'm looking at is seeing exactly what price action is doing after we get out of that area. If we could break this area with aggression, that means that we are stronger in this area than we were previously. So we have a higher chance of breaking this high day because buyers are able to bring it past a certain area that buyers weren't able to bring it above before previously, as you guys can see right here, which is why I make these zones. Same thing with here, this downside. You can make a zone right in this area. Now, it's not as strong of a zone because we didn't get a lot of touches. We got a lot of reactions down here, and it finally broke under it and then held right there. But if we're able to break that with aggression, we're obviously going to see more downside. Now, I don't trade that way. I'm only looking at this upside unless we have a key level all the way down to there. But for this, that also gives me context on how price action moves, because if we're able to break this area, then we have a higher chance of actually breaking out of this high day, which is that 600 level, and then we're able to take that 600. I'm really seeing how the aggression is and how we get up to that 600 level. And you guys can go back and do that anywhere, right? I obviously do this real time, but just for practice, I want to see what is reacting the most. Let's go right here. We see that the bottom of this candle makes the low of this zone, and the close of this candle makes the top of that zone. We see the reaction there. We see the reaction there. Once it broke under, it had a very nice move. Sometimes it likes to retest that area and then go. But these are the zones that give reactions intraday. Now, I don't trade off of them. They just help give me context, because if we're able to break this zone, we know that the market is definitely going to be weaker, because this is an area that it was holding previously. So this is basically just support and resistance. So now I'm going to go over stop losses. Okay, so let's go into the stop loss and risk management. So you guys know that my stop loss was under this candle low right there, but why did I put that there? Now, the reason being is because I'll know if I'm wrong at that area. The reason why I put my stop loss where I put my stop losses at is because that's where I know I'm going to be wrong. Now, how would I know I'm going to be wrong at that specific area? Well, because, number one, at most I'm going to lose is negative 5%. So it's either my stop loss sits right there, or I'm going to lose negative 5%. Sometimes it goes to negative 8%, but that's super rare. I usually get around negative 5% on my stop loss. But if price action goes up to here, like I said earlier, think of it like a dam. The dam cannot break, and then the water comes back in. And if it does, then I know it's going to be a fake out and I'm wrong on the trade. Because if we come all the way up to here and then we come all the way back down to here, especially where we opened at on this candle, I know I'm wrong. And I'll accept the loss and move on to the next trade. Because if we come all the way back to here, the dam broke here. This is where we opened at. We should continue to the upside, which is exactly what we did. And if we don't, then I know I'm wrong. Now, we're obviously going to give it a couple cents, right? This is 10 cents. Because it could come down, retest that area, and then go. But I'm not giving it more room than it needs. And this is why I was able to lose negative 3%, negative 5%. So let's go over a trade that I actually lost today. I only took 2 trades today. I lost negative 3.8%. And then I also made 23%. So that was a 23% example. Let's go over the loss that I took today. So this 410, I literally took this to the upside today. And I lost 3.8%. Now, right in this specific area, we got in right there. It came all the way up to around this 411.50, and it came right back down. My stop loss was right at this high of this candle. So right in this area right here was my stop loss, and as you guys can see, I got stopped out. I just move on to the next trade, right? My stop loss, I know I'm going to be wrong right away when price is able to get under this area. Once price got under that area, I stopped out there, and I lost around 3.8%. Now, if this came up and went after that, I wouldn't care, because I'm risking such a small amount to make 15% plus. As you guys just saw, I made 23%. So I don't care what happens after I sell at my stop loss. The reason why is because it's how I think about my stop loss. I think about it in a positive note, because this is the only thing that allows my winners to compound. If I take a small loss like that and it allows my winners to go like this, then I'll take a loss every single time to potentially make this reward. Versus a lot of people, you guys think about it backwards, where you guys take a winning trade and then you guys panic, you don't sell your stop loss, you average down, you make a bigger loss than you need because you're avoiding losing, which is so crazy. You avoid losing and actually lose more money. And this is why your chart looks like this. So even if I stopped out there and then it went, I know based off my stats and based off the years of trading that I just move on to the next trade, because this is the only way that my winners will compound, depending on how small a loss you take compared to your reward. And if I lose 5% to make 15%, that's a 1 to 3 risk reward. 1, 2, 3, small loss. I just move on to the next trade, because if I make this even bigger, my winners will not be able to compound as much, just like that. That's why a lot of people break even, because you don't look at it in a stats-based way and you look at it in an emotional way. and you avoid losing and actually lose more than just stopping out of your stop loss. So that's why I really focus on my risk management, because that was one of my biggest problems. So my stop loss was right there because I'll know I'm wrong right away. And most of my stop loss is going to be was right here. But I knew if we came down, since we were already $1.30 from where we entered at, I was waiting for that 412, then I'm going to be wrong if it comes all the way back down to here. And I was wrong, and I move on to the next trade. Now, the reason why I was waiting for that 412 was because since it's Monday, these contracts are further away from expiration, so the contracts didn't really move like that. And based off my stats, I would rather take a negative 5% loss than a 8% win based off my stats, because if I have that same exact mindset on winning trades, and let's say I take a win at 8 to 10%, I'm actually leaving 50% of the profits on the table, because my profitability, my profits actually double if I wait from 10 to 15%. From 10% to 15% is not just 5%, it's actually 50%, because I'm making 50% more if I wait for 15%. And my expectancy per the trade is around 15%. So on average, our trades go around 15%, 15 to 20%. And I'm significantly more profitable if I wait for 15%. Yes, I might sacrifice a little bit of my win rate, but that's okay because it's such a small loss. I'd rather sacrifice a little bit lower of a win rate. So let's say 80% at 10% profits versus 75% at 15% profits. I'm making 50% more profits for a negative 5% difference to my win rate, which significantly increases my profits overall. It's just a numbers game. But the way that I do it, there's a reason why I do it, and that's it. But it's all based on stats. Now, you guys know that there could be different types of orders, like I went over earlier: market order, limit order. Now, the way that I trade, we do market orders. But you could also limit order. We have to know what a limit order is. And a limit order is basically just an order you place to get filled at a specific price. Now, the reason why I don't do that is because this moves a lot and it moves fast. And I want to get filled ASAP, and I know I'm going to get filled at a good price because we take the most volume contracts and they're the most liquid. So their spreads aren't as big because they're the most liquid contracts, which means that if we market order, that means we're going to get filled ASAP, and we're not going to get that bad of a fill compared to the limit order because we're getting filled real time on an option contract that is very tight in spreads. So even if you limit order, we're basically going to get filled at the same price almost. So that's why I market order. You really don't need to know too much about limit orders. Just know that you can put an order in for a specific price of the contracts. Market order, you get filled instantly at the best available price at that specific time. So now I'm going to go over the price action and what I like to see. Now, let's go over good price action, right? This is how price action is supposed to behave, aka the candles. We come up to a specific level and we react there. The reason why we react there is a huge wall. It's the dam. And we reject a little bit. Now, the reason why we reject is because it's such a huge wall that it can't break like that because we don't have enough buyers in that area. So we come down. Now, the come down, the drawdown, is very important because I want to see if these sellers are actually there or if it's just people taking profits because there's a huge wall right there. So what a lot of times happens is we come down and then we come up and then we finally break it. Just like the Q's example that I showed you guys earlier, you guys could see on QQQ, that's literally what happened. We had a wall at the 600, price wasn't able to break that. We came down and then we went. Basically an upside down H in this example, and if we go to the downside, it would literally look like this. So that's the price action I'm kind of looking for in order to break that wall. If price action came all the way down to here and then like all the way back up, I would need to see another reaction there to make sure that these buyers are actually able to hold themselves and it's not just a one run up and then it stops and fakes people out. If buyers are able to actually hold themselves up like this, that shows me that, let's say previously, these buyers are strong enough to defend themselves, and these sellers aren't able to bring it as low as they were previously, which shows strength. Some people call it higher highs, higher lows. I find out the why and define the why on why people like to see higher highs, higher lows. It's just basically if price action was looking like this, buyers are able to hold it up higher and higher and higher than they were previously, and buyers are able to go through higher and higher and higher than they were previously, which is great. People that do patterns, it works because of the price action behind it, but it doesn't always work because there's more to it. So, like, for example, if you get a breakout like that, buyers are able to hold it up higher and higher and higher than they were previously. Not because there's a pattern here is why it went. No, it's because of the price action. And it has to be at specific areas. You can't just see this and then take it. I hate patterns. I find the why of everything, and then I apply that to how I trade. So, like, for example, the trade that we took today came up, reacted there, price held it here, and then we were able to hold it here, and then we were able to hold it here before lifting off. And then we were also able to break this to the upside, which shows strength. And then we were able to break this, which shows a good amount of strength. And then we got a higher candle close than we did previously. And then the buyers were able to really step up at the 600 level. So now let's run you through an entire day, right? So in the morning pre-market, I look at Econo Day and eWhispers to see the earnings, to see the economic calendar. Then I go onto the 1 hour time frame. So let's go to Tesla, go to 1 hour time frame here, and I identify that we have reactions in this area. So I'm going to mark out the 380 level. And next up, I'm going to look for the price action. So then we go to the 1 minute time frame. We see how the price action is moving. Now, obviously, we didn't get there today, so we can't take 380 to the downside. We took 410 to the upside because that's what's set up. But we see how price action is moving, and then that's when we enter. Same thing here with QQQ. We go in the 1 hour time frame. We saw that it reacted, and then we go to the 1 minute time frame. We see the intraday setup right there. We want to make sure it reacts because of the damn example that I showed you guys. We see how price action is moving, heading up higher, 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 higher. We had a zone right here. We see that the buyers are able to hold this up. We actually broke out of that intraday zone right there, and buyers are able to hold it up higher, higher, higher. Now, how do I enter this trade? The time of sales, right? We see the numbers on this screen. So what do we look for? Okay, so there's a couple things we look for. Number one, I have the bid, price, and ask. Now, I'm looking at speed, aka velocity, and aggression, which basically means how fast we go from 70s. So this is what I look for. Like this, I don't really look at these numbers because it's just the whole number. I want to see how fast we go from 70s to 80s to 90s and then break it. And I also want to see how fast this is moving. Now, in order to break a dam, we need enough buying pressure, right? We need enough water to be able to break that dam. We can't break a dam if it's slow water, which means that if this is slow, we can't take it. We need to see aggression. We need to see velocity. We need to see that speed. So let's take a look at what we did at that level. Okay, can you guys see the change in speed right there? The speed is there. Speed is there. It's cool. It's cool. It's cool. It's cool. And look how much faster it starts to get once we break this level. Oh my gosh, we're able to break that. That is the water flowing. We also want to see aggression. We're at the 90s, we're at the 90s, we're at the 80s, 90s. Number one, we're holding up 90s. That's what I'm thinking about. I wanted to continue to hold up 90s, see how we go in the 70s, but then we pop right back in the 80s. We're able to hold these 80s, 90s, 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 and then we just went from 90s to the 10s, 20s, 30s, just like that, right? We're in the 30s. That's aggression. That's what I like to see. Now, this one kind of jumped up a little bit, but we're seeing that aggression. We're seeing that velocity. Buyers are there, and we're able to break that wall that was there previously. Let's go over another example of the time of sales. So what we're identifying here is we came down. Sellers are bringing this down more and more, which is good because we want this downside move. We see that buyers aren't able to bring it up as much, which means that it's weak. And we had a little bounce off this zone, this little area right here of 165, but that's because it's a wall. There's a big wall there. There was a huge wall there. There was over 1 million shares there. But can you guys see the velocity? Look how fast this thing is going, right? But we want to make sure that it's volume to the downside, because there could be a lot of volume here, but it could be buyers. So how do we identify that? By the aggression. I want to see 30s, then 20s, then 10s, and I want to stay under that. I want to keep staying under each level. So we're in the 20s right now. The next thing I'm looking at is for the bid to go under 20s and the ask to hold under 20s. So we're keeping, we're staying under the lower 20s, right? We're kind of fighting back and forth here in the 20s. And then we're just getting lower and lower and lower. And we're actually staying under these 20s, and we're under this 15s right now. We're kind of staying under these 15s. We just retested 15s. Now we're under this. We're under this. We're under this. We're staying. We're back retesting at 20s, which is fine because there's a low green candle right here. Something that I picked up over the years is as long as we stay under 50% of that previous big candle, I know that it's just people taking profits. It's just like easy little trick. This is great because we retested 20 for a second and then we're back down in the 15s. And look at that, right? The velocity's here. What we want to see is aggression. We retested 20s and then we went to 10s and now we're in the 5s. Now I want to make sure we stay under 10s, and I want to make sure that we're able to stay under 5s, and then it stays 5s, 5s, 4s, 4s, 3s, 3s, 2, 2s, and then it lights up that key level on that chart. See how we're able to stay under 5s? That's very weak because we're at a very strong key level, and the fact that we're able to stay under these 5s is pretty great. 5s, 2s, 1s, like this is where I'm in. And you guys can see this is absolutely lighting up this 165. That's a great sign because that wall is getting eaten up right there. And oh my gosh, look at that. Let's hear my reaction.
Oh, fuck? Yo, half off right there. On it.
Oh my god, bro.
Oh my gosh. What the fuck?
Just like I said, there was a huge wall there, so it was a big wall. In order to break that big wall, we need a ton of pressure coming in. Once that breaks, it is going to break just like that. So then literally putting it all together, for this, we had the key level there. We got that on 1 hour time frame, and then we saw an intraday reaction at that 600 level on the 1 minute time frame. Then we made sure the price action looked good. Buyers holding up higher and higher and higher than they were previously. We had the little zone right here. Buyers were able to break out of that, which is a great sign. Then we need to make sure that the time of sales is looking good. It looked good on that break of 600. That's when we entered. Our stop loss is going to be under this previous candle because that is where we know we're wrong right away. Then we just wait for that 1 to 3 risk reward around that area. I was trimming as we're making these new highs just because we are pretty extended and I could have saw a pullback that could have stopped us out. So I started taking some off right in this area right there. And then once I saw that we were able to actually hold up in that area right here, once we made that new high, that's when I said that 601. Once 601 broke, that's when I got fully out right there because we did make a pretty big move for the day. On average, Qs doesn't move as much. And from this 595 to 601 is a $6 move, which is a pretty big amount for only 30 minutes into the morning. So after a dollar move, I was like, all right, 601, that's when I'm going to be fully out just because I know how stuff moves because I've been in the market for so long. And if any of this was confusing or too much, don't worry because this might be your first week trading or first day trading. You're not going to get this in a couple days, right? You want to do stuff that people can't do. The reason why a lot of people aren't profitable is because they don't want to do the hard work, right? Trading is not that easy. I make it look easy because I've been trading for so long. This takes time. And if it was easy, everyone would be able to do it. I make it look easy. It's not that easy. I just been in the market for so long. And that's the entire reason, right? So that's why you guys need to put in the work. And if you don't understand something, that's where you look up. You're like, all right, if I solve this problem, I'm able to unlock a new skill. So for example, if I don't fully understand time of sales, which you're not going to understand fully in this couple hour course, we just figure out, okay, this is my weak point. This is what I need to focus on. And I'm going to continue to focus on learning the time of sales until I'm good at time of sales. And then I focus on my next problem. And then I focus on my next problem. And then I focus on my next problem. Problems are just stuff that is meant to be solved in order for you to level up as a trader. That's it. You shouldn't be able to understand this in an hour, right? It shouldn't be that easy. So now I'm going to go over mindset real quick and the psychology that's needed. Just because, you might be new at trading, but the psychology is one of the most important things because the strategy is the easiest part. The biggest problem is actually stopping out your stop losses, taking profits where you're supposed to take profits, and just having the proper mindset. It all comes down to just your psychology. So that's what I'm going to go over real quick for you guys, just because this will allow you to stick to your entire plan. Because the strategy is the easiest part. The hardest part is actually sticking to that. That's what I want you guys to realize. So I call it the profitable mindset. The best traders are not the smartest, right? They are the most disciplined. They know how to lose well. Just like I showed you guys, compounding only happens if we take small losses compared to our winners. And our job isn't to predict, right? I'm not saying, okay, I think the market's going to go up. I think the market's going to go down. No, I have all of my confluences, and it tells me exactly, okay, this is where I enter for the highest probability. And I'm just detaching from the outcome. I don't care if I win or lose. I know my plan is going to make me profitable in the long run, and that's it. The subconscious, it was one of the most important things, right? Every time you don't follow your plan, you teach your brain that emotions win if you take a trade that is ending up being a winner. So if you take a trade that ends up being a winner, but you didn't follow your plan, you teach your brain that that's okay to not follow your plan, which is why a lot of people lose, because if they don't stick to their stop loss and they end up winning, that teaches your brain to just not win, right? And not stick to your stop loss. So you have no longevity there. Your power isn't in control, it's in letting go. If you can let go of your stop loss every single time, and you take profits every single time, it really doesn't get any easier than that, right? That's where our power is in letting go. Now, we have to become the best loser ever. I have one of the best risk management plans out there, and me personally, that was one of my biggest problems and my biggest weaknesses, and I was able to turn it into one of my biggest strengths. A lot of people, when they see the way that I trade, they're like, oh my gosh, how are you able to lose so small compared to your winners? It's just because that was one of my biggest weaknesses, and I was able to turn it into one of my biggest strengths. Pros lose small. As you guys saw, I lost 3.8% to make 23%. And amateurs avoid losing and blowing up their account. People avoid losing to the point where they end up actually blowing their account, which sounds crazy, but that's the truth. So you have to be proud of sticking to your stop loss, because that was a win. I didn't get mad that I lost 3.8%. I was actually happy that I was able to keep this under around a negative 5% stop loss, because this is what allows my winners to compound. You have to look at your losers in a little bit of a different sense. Now, most traders will not make it. The reason why is because they just trade to make money. If you're just here to make money, you're not going to be obsessed with the stats and the numbers. You're not going to be obsessed with actually trading. You're just here to make money, and you're not going to make it. They also think they need to win now. Not true. They also size big too fast because they want to make money now. They build habits by chasing dopamine and not data. They see the money going absolutely crazy, and then they just build the bad habits. And if their stop loss hits, they actually don't sell, and they actually average down because they're chasing dopamine and not data. Everything I do is based off data. Everything I do is based off the stats and the years of stats. If you are surprised by the loss, you aren't trading and you are gambling and hoping. I mean, this is self-explanatory there. Every trade that I take, I know that I could lose X amount. So for example, I know every trade I could lose $5,000, and I'm okay with that. If you're not okay with that, then you size down. Simple as that. And I have a predefined stop loss, so I know I'm going to lose that amount if I lose. Patience keeps you alive. The market does not owe you anything. If you are hunting for setups out of boredom, you already lost a trade before you click buy. Because if I'm trading out of boredom and hunting for setups out of boredom, that's not actually going to be part of my A+ plan. And if it's not part of my A+ plan, then there's no reason for me to trade, and I'm just gambling. Now, our goal isn't to win. I don't care about winning. I don't care about losing. What I care about is repeatability and having a system that I can continue to keep repeating. Because anyone can hit a home run once. Anyone can hit a home run once, right? I can go on the base and hit a home run. That's not what I'm impressed by. I'm impressed by longevity. So a trader that has been trading for years and continues to have great stats, I know the work that was required to continue to keep those stats up, and they have a proper system. Now, you guys need to rethink your life. You break your rules because deep down you still think you are smarter than the market. The moment you surrender that illusion is the moment you start trading with profitability in the long run. If you don't think you're smarter than the market, then you would stick to your stop loss, you wouldn't trade out of boredom, and you just follow your plan. It's all about how you react. Mindset is everything. It is how you react to stuff. That's the whole reason why psychology is super important, because this is the only determining factor is if you follow your plan or not is based off you. So it would be the difference between profitability. That's literally it. Because it determines when you click and when you don't click. Money and trading. You have to stop thinking about money or else you'll fail. Because money has no business being in trading. This is the only thing that allows us to get in positions, but it should not determine when I sell, when I enter, anything like that. Money is just something that we use. It's just fuel for your vehicle, and the vehicle is the plan that you guys have. So a lot of people come to me and they set money goals. You guys should not be doing that, because if you don't make, let's say you have $1,000 money goal for the week, let's say you don't make that and you come up short, you might force a trade. Or if you make over that, you might hesitate on new trades. So I don't set a money goal at all. There's no time frame to profitability. Emotions equals money is one of the most important equations you guys will ever hopefully remember in trading, because if we can figure out how to get rid of the money, then we get rid of the emotions, right? Just simple as that. And we can't obviously get rid of the money when it comes to trading, so we have to think about the way that we trade a little bit different. And if you ever paper trade, you know that there's no emotions when it comes to trading, because we're not trading with real money. So that's why I tell you guys, once you learn the strategy, get out of paper trading ASAP, because that is not going to teach you the right way of trading, because emotions is involved. We're not robots. So we need a mindset of a killer. We are a probability manager. Our job isn't to be right, it's to execute with our edge. For example, my edge is being able to really see real time the buyers and sellers through my time and sales. I'm able to really read time and sales really well, and also my risk management and just mindset overall, right? That's my edge. And if you don't have an edge, then you have no business trading, right? Because I can fully understand and read time and sales. My risk management is insane, and the mindset around all that is up to par. We have to detach from the outcome and obsess over the process. That's all I think about is trading, right? Especially when I first got started, all I was thinking about is trading. I did not think about the money whatsoever. You don't need confidence, you need conviction. Confidence is emotional and conviction is procedural. All I care about is following my A+ checklist. I don't care how I feel or anything like that. If my A+ checklist is there, that's when I enter, and it doesn't matter how I feel. So the reason why break-even traders hesitate is because you guys are still trying to be right. You guys need to let go of that. You guys are also waiting for perfect conditions instead of your triggers. So for example, if my key level is hit and the time of sales look good and the previous price action looks good, that's when I enter. I don't wait for the moon landing and this and that and everything to align and the stars. Like, I don't care. What I care about is my A+ checklist. If that hits, that's when I enter. I don't care about being right or wrong, because I know my risk management plan is just going to set me up for success in the long run. Now, you guys need to stop being a victim to the market. The market is a mirror and it reflects how you treat discipline. That's super important, because your P&L will literally reflect how you treat discipline. You'll be able to see my P&L like this, and your P&L looks like this, because it's just how you treat discipline. You don't size up because you don't trust yourself. I wouldn't trust you either, because your stats are terrible. You exit early because you hate being wrong. So if you're only up 5% and your plan tells you to sell at 15%, you hate being wrong so bad that you end up selling at 5%, which risk to reward wise that it makes 0 sense. And you watch great setups go by without you because you always need more confirmation. You always hesitate. Anti-hesitation. So something that helped me was I was just anchoring myself to the stop loss and not the outcome. So every time I would take a trade when I first got started, actually changing the way that I trade, which is about 1.5 years into when I first got started trading, I would just anchor myself to the stop loss, and anything that happened after that would be, free game, right? That would be amazing. But I would only focus on my stop loss, and that actually helped a lot, because that's the only way that our winners are able to compound is if we minimize these losses. You're avoiding losing. You don't want to be wrong on the trade so bad. You actually skip trades and are avoiding discomfort. It's okay to be uncomfortable, right? Losing is not comfortable. You'll actually find comfort in being uncomfortable. And that's why I like the way that we trade so much, because people just can't handle it. And it leads to late entries, taking profits too early to secure a win, holding losers too long and hope they turn around. So that's why I don't avoid losing, and I just embrace my losses because they're so small compared to my winners. And they wait for the perfect conditions. Every great setup has a risk. Nothing will ever 100% line up. There is no such thing as a trade that feels certain, and when it does feel certain, it's usually too late. The only way a trade feels certain is after it breaks, and if after it breaks, you're already too late on the trade. Your risk to reward is going to be super messed up. You enter here instead of here. Your risk is here, and this is a huge risk versus this. So it's all about probabilities. You are journaling wrong. That trade sucked. I knew I shouldn't have done that. I had a feeling it would fake out. That's all emotional journaling. You guys should never say, oh, that trade sucked. Why did it suck? Why shouldn't I have done that? I had a feeling it would have faked out. Why'd you enter? And what made you think that, right? You need to make sure you guys are journaling the proper way. So conviction. Conviction is not a feeling, it's a decision. Just like I was talking about earlier, if I see it at A+ setup, I'm getting in without hesitation and the stop losses are defined. You didn't know the outcome, but I trusted the process. I don't know if I'm going to be right or wrong. My win rate, let's say I have an 80% win rate. I have an 80% chance of being right on this trade, but I didn't know the outcome. I just trusted my process. When I say I don't wait for confirmation, it's not ignoring the criteria. It's ignoring the emotions and visual perfection. Now, we have a checklist. We need to make sure that we have an A+ checklist so we know exactly what to stick to and the criteria are met no matter your feelings. Stop loss and mindset. Like I said earlier, your job is not to be right. It's not about the outcome. It's about trusting your plan. You will never have a 100% win rate, so stop acting like that. If you don't sell your stop loss and you think that you have a 100% win rate, it's not how it works. It's not about how much money you can make. It's about how much money you can keep. Super important. The best traders still lose and a bad trader can win. That's also important because we can realize that no one has a 100% win rate, and it's all about how you manage your losses. The market does not care about you. The whole game of trading is to have an edge in managing risk. You have bad habits that make bad trades. If you guys don't sell your stop loss, that doesn't make it a bad trade. That makes you having a bad habit make that a bad trade. One undisciplined trade can undo 10 perfect ones. That's why we need to stay focused and wait for the best to leave the rest and make sure we stay disciplined. This is one of the most important charts you guys will ever see. So they both have a 70% win rate and they both have a 1 to 2 risk reward. Just one guy decides to hold past their stop loss. He makes 1,000, loses 500, makes 1,000, makes 1,000, lose 500, makes 1,000, makes 1,000, lose 500, makes 1,000, makes 1,000. And he's up 55% of his account in 10 trades. This guy, he makes 1,000, loses 2,000 because he didn't want to sell at a stop loss. So he ended up 4xing his loss, and he lost $2,000 there. Then he makes 1,000, loses 500, makes 1,000, makes 1,000, loses 500, makes 1,000, and now he gets super confident, and then he loses 2,000 again because he decided not to stick to a stop loss, and he makes 1,000. So out of 10 trades, this guy only is up 10%, which there's no cushion there. You're basically break even. Versus this guy's up 55%. And since he's able to follow his plan, he could lose 1, 2, 3, 4, and still be up more than this guy. So he has a lot of drawdown protection, and this just allows crazy compounding. So, and it's only a 1 to 2 risk reward. Imagine a 1 to 3 risk reward. And 70% win rate's pretty good. So you guys have known these zones, right? We could also, what I like to do for fun, is play bounces or reversals off of these areas. Now, that's exactly what I do in my challenge videos, is I take bounces and reversals off of these zones. For example, as you guys can see over here, we could have took a bounce off this area. We could have took a bounce off this area. We wouldn't be able to know this is a zone until right here, but then that's when I'll be able to take that bounce. Now, I could have had another zone right here. It just literally depends on how the price action is looking on the higher time frames. And I've been able to take a reversal right here, put my stop loss at one of these highs, but this is exactly how I trade that way. Now, I'm going to show you guys a video of me doing this live, and it's a full challenge video, and I'm literally just showing you guys the proper risk to reward, and I'm also showing you guys, my win rate, as well as just entering and managing the trade real time. So now we're going to take a look at that.
Today's day one. We have $5 and we're gonna look for a bounce at this area because we came down so much. If you guys take a look at the 1 hour time frame, we came down quite a bit. We're looking for a little bounce right here. I might get in off of this area right here. All right, guys, we just got in. We had to sell this at $13 right here. As you guys can see, we had a little zone, and once we broke out of it and retested it, that's when I got in right there. In order to get to $13, we have to get to 525 somehow, and we have 15 minutes left. So with that being said, wish me luck. This is a riskier play, but in order to make money with a $5, you have to be more riskier. We're getting this bounce off this 1 hour after coming down crazy out of nowhere in the last 3 hours. It's looking good. Sit back, relax, and let me work. Bouncing off this 522.20s right now. These contracts, bro, I thought $10 was hard. $5 is even harder because these contracts, again, are in that dead territory. Once we get to like $20, $30, then we're good to go. But the first $5, $10, $15, $20, that's the hardest. Whoa, we got the $8 on the contracts. Whoa. Oh my gosh, if we keep momentum. Like you guys saw the $10 challenge. If you guys haven't watched it, go ahead and watch it after this video. Like all we need is momentum. You guys are gonna hear me say it all the time. Momentum will carry these contracts if it goes there fast. If it takes too long, this thing is gonna keep running away. Keep going. Momentum. $10 on the contracts. Now we get to $13 because of the fees. No way, bro. What is going on? Keep going, keep going, keep going. $10 on the contracts. You guys see it. See, we can't pull back. We gotta keep going, keep going. These were $10 contracts or $20 contracts, it wouldn't have felt like that. It's kind of fucked. Bro, gotta go. Fly. Come on, $5 to $10 today. Like this. It has to shoot up. It has to shoot up like 50 cents on this candle. No way we're about to get this. $11 in a contract. Fly. Can't pull back. Don't pull back. Don't pull back. Come on, bro. Like 20 cents up. You're there. You're there. Ah, it's over. It's over. You can't do that. Contracts are 8, 7, 6, 5. Contracts are still holding up somehow. They're at 10, 11. Oh, because now we're at $10 contracts. So that's why they're holding up a little more. The $12, and we're going to hit it. It's going to hit. Bid's 11, though. We need $2 more above that. No way, bro. I didn't put that as a resistance line. That shit is fucking, sell that shit. Touch 13. It touched 13. 13 on the ask. 13 on the ask. Bro, we're at $13. Like that. You guys just saw that live. Bounce off that zone. Why? You guys can see the 1 hour. We fell so much that these contracts got absolutely swept. So then we started holding this 520 area. We got in once we saw a clear indication of that reversal on the 1 minute time frame. Once it held this zone right here. And then somehow the market decides to pump. We turned $5 to $13. After commission, we're at $12 right now. It's gonna take us 19 days to reach our goal of $1.3 million. Next day is $20 and it's just gonna get easier, but at the same time I only have one chance every single day and I have to double it every single day. So $100 within like 5 days. Pretty easy. Let's get it. All right guys, I'm trying to enter puts here. We are rejecting this high zone right here. We just got filled for 10. Would have put my order in for 20. So we don't even have to come down that far. We only have to go to 527, but we just turned $10 to $20 because these contracts are so nice. These are the contracts that we like to take. If we hit this low, these contracts are gonna be at $50 from $10. But these contracts got swept so much that they're so cheap right now. We're already up 30%, 40% right now. I said the hardest part about this video is gonna be the $10 to $100. So far it's looking good. I decided to move it to $21 to account for commission and fees, just because if we come down to there, like it's gonna hit $20, probably $25. It's not about making money, it's about sticking to your plan. My plan, my goal, the reason why I got $10 to $1,000 is because I stuck to my plan. I didn't get greedy and I stayed humble. I'm sticking to my plan of the $20, $21 with commission and fees. The moment I start getting greedy is the moment this challenge fails. We tried to go up, came right back down, and now the contracts are swept. They're at $8. So the red line dropped. We just gotta drop with momentum. Time is running out. 16 minutes left on the clock. We're at $10. We're at break even right now. The goal is to reach double the account today, $20, or else we fail. It can't consolidate like this. We need momentum dropping like that for these contracts to give us this $20. Wow, we're at 14. I probably make it look so easy on this. It's actually harder than it looks. We're up 60% right now. 80% right now. It is going to hit $21. That's how we do it, baby. That's how we do it.
You're throwing up a gang sign again, bro.
Day 6. Is that a gang sign? This is how we do 20. 20. Now we're back down 13. One push. Yeah, but the red keys falling. We're at 18. We sold. $22. Where the fuck's the sound? Day 2, just like that. We started off with $10 today. We made 11 from commissions, from fees. We're up to $20 on the account. Day 2. Now we gotta get it up to $40. See you guys tomorrow. So I'm looking off the bounce from this 510 zone right here. You guys are gonna see exactly how I found this on the 1 hour time frame. You guys can see it's super reactive in that area previously, and then that's where it bounced. So now you guys can see this 1 hour kind of struggling in this area. I'm expecting some sort of bounce if we could hold this zone intraday on the 1 minute time frame, and then we'll be able to take these contracts. Remember, we're at $20 right now. Contracts are around $16, so this is gonna have to get to like $36. All right, so I'm gonna get in here. All right, guys, as you guys see, we're in. We're at $21 right now, $22. We're bouncing off that zone. You guys saw exactly how we got that zone on the 1 hour time frame. Now we're at $22. We're taking this bounce here. It's gonna have to get to 512 in order for us to sell for $20. So this is gonna be about 120%-ish if I'm doing the math in my head correctly. So we have to make a bigger trade than just double it today because the contracts are not gonna be exactly the same price and everything like that. We're taking a bounce over there. We got in right around that area, about $18. We got feel a little late. This red line's coming down. This might be an easy trade today. Knock on wood though, because like I always say that and then it never works. Remember, momentum is key. We had to just go. Like we could just jump, and if we jump up to here with momentum within like one candle, we pretty much got this sell because these contracts will start flying. Red to green. See, contracts just jumped a little bit with that momentum. But as you guys can see, we're at $28. All right, we're almost double on this one, but again, it's double the account, not double the contracts. So we had to double it a little bit. Momentum is coming in right here as well, so it's looking really good. Oh my gosh. Remember, momentum needs to keep going. It can't come up then come back down. The contract gets swept. Ay, ay, ay. You can't can't do that because then it's gonna take way too long. The market literally closes in 25 minutes. Look at that momentum pop again. This might be the easiest day. Hopefully, fingers crossed, keep it going. We're at $30 per contract right now. We're so close. Like if that candle kept going, we'd have sold it. We'd been done. Contracts are getting stuck at $30 right now. Look at this, $32. We're about to sell. About 40 cents away. 33, 34, 35, 37. Bro, I said 38. Come on. So, bro, look how easy that is. That bounce off that 1 hour zone. We're done. $20, easy challenge 2. Keep doing it, back to back, bro. Back to back, day 1, day 2, day 3, we're done. We're at $40 on the account. Now we have to go to $80 tomorrow. I mean, this is getting a little bit too easy here. Like, I'll be hyped once we pass this. See you guys tomorrow. So we're trying to hold this area right now. I'm gonna get in for the $5 challenge. It's at $40 right now. We get 2 contracts here. We're playing this to the upside. We're trying to hold this area right here. We just got in for $20 a piece. We have to get to $40 and we will officially be at $80. We got 30 minutes left. See what happens. Look at this, look at this. This is insane. And it's still going, but we're not done yet. We have to get to $80. Come on, bro. Look at that. Look at it go! Look at it go! Look at it go! Yo, no way, no way, no way, no way. Bro, bro, bro! Bang! Bang! Like that, look at it bounce! Look at that fucking bounce! Bang! $80. Boom, boom. Next job, 160. That's insane. $80, 160. 1 million is the goal. Let's go. $80 to $160. We're gonna do that today. We are gonna get over that 3-figure mark. Let's take a look at what we're looking at on the 1 hour time frame. You guys can see we are starting to fall, but we have this support right here. We go to 5-minute time frame right here. We are starting to bounce as well. So we're taking a look at this to the upside. I want to see if we can take this to the upside. Let's see. Fuck it. How many contracts? 80 divided by 14. 1, 2, 3, 4, 5, 6, 7, 8, 9, 7, 6, 5, 4, 4, 5. Let's get in. Fuck it. All right, we're in. 16 times 2, 32, 34, 35, 36. Did I just fucking sell? All right, guys. We can get one more now. All right, we're in. So we need a 30. What the fuck is it selling for? Let's get 5 more. Actually, maybe it's a sign. Maybe I wait. Like, damn. See, it's bouncing. I told you. Bro, it's put me at the worst spot ever. All right, we're in these calls. We're getting this bounce off this zone right here. You guys can see all the bounces here. So we are in currently. We need to get to $60. Oh my gosh, 60 beans? Oh, it's not even that bad. Get up there. Come on, let it rip. Easy, easy, easy. Look at that bounce, easy. Contracts, we're at 27, now they're at 35. That's 20% right there. Keep going. 27 to 36 right now. We have to get to $60 a contract. The stock only gotta move $1. So we there, just gotta wait. Oh yeah, 68% now. Come on, come on. That's easy, easy bounce, bro. That's fucking, we're over $100. Come on, we're over $100 in account already. Keep going. We're back down. Bro, we were so close. You're really gonna come back to break even? I will full port my main account right now. Imagine. That's like some togi shit, bro.
Some togi shit.
Do some stuff. We had the bounce. It bounced. Came right back down. It's literally about to hit break even. We were just up 50%, 60%. I'm tired of this challenge. Guys, I'm officially a fitness influencer now. One-on-one training. Oh, it's literally at break even. Guys, if you're making it this far in the video and haven't subscribed, 90% of you guys aren't subscribed to this channel. Go ahead and subscribe or you'll never see a video again.
Good.
Yeah, that's what they're gonna be like, bet. Not subscribe, unsubscribe. Bounce that bitch. Bounce that bitch. Keep fucking bouncing. That's right. I knew the whole time it's gonna bounce. Challenge is not over until I say it's over. We're over $100 now. Get to that red line. It's the only thing that you're here for, Spy. Nobody gives a fuck about you. We use you until we don't need you no more. 70% right now, 72, 50%, are you dead? All right, I'm sorry, bro. Spy, no. We were right there. I'm not doing this shit no more. I'm about to sell you. Come on, bro. I don't got time for this fucking shit. You're dropping? You're dropping? Red to green? Red to green? Come on, bitch. You got 20 minutes until market closes. 10 minutes. Oh, red to green, red to green, red to green. Oh! Did it sell? No, it's, wait, did it sell?
It sold.
Oh! Look at that shit! Oh! What the, where are you going? Alright, you sold it. Bro! What? The contracts went to 100? We're at 160, but what the fuck? This contract just went from, what the? Wow, we could have been at a band. Sorry, we stuck to our plan. That is literally running. It's literally running. keeps happening. After commission, we are slightly above 160, but for the sake of this video, we're at 160 exactly. We have 13 days left to reach our goal of $1.3 million. If I do that, I'm quitting YouTube and I will see you guys never. We're turning $160 into $320 today, or else we fail the challenge. And it looks like this. Right now, what I'm looking at is this bounce right here off of this. I could bounce. It could go either way right now. All right, we're in, boys. 7, 14. We wanted to get to at least 20 for like commissions and stuff. There's our limit order. Damn. Oh my gosh, that's kind of far. We gotta bounce off here and then fly. I mean, hopefully with enough momentum, we could like, it will hopefully sell around here. We got 16 minutes left and we gotta bounce with momentum. I don't know about this one, boys. It's only $1 away. Like, come on. 160 to 320 today, right now. It's bouncing. So I got the move right? We're at $7. You guys do the math. I'm up 21% right now. So if you put 100 grand in this position, 21%, that's $21,000. That's $21,000 right there. Look at that bounce. What else can bounce?
What?
Just keep PG here. Yes. Yes. Come on. We're halfway there. We're at 35%. Come on, fucking pump, bro. This shit's not funny no more. Come on, we got the bounce right there, so keep bouncing. We can't fall. The line came down, so that's good. You saw the red line just fell. 5 cents left. 9 cents. 8 cents. 7. Look at it go. Look at it go. Look at it go. Yes, pump. I would think I'm faking this shit, honestly. Like, how the fuck are we getting this? 64%, bro. We're literally 65%. We just made $100 off $100, basically, almost. Oh, you're so fucking close. Come on, give it to me. Yep. Oh, this is it. Bro, it's it. It's at $15 right now. This is it. We're at 90%. Wait, what? But it says I'm up 130. Oh! Wait, what the fuck? What the fuck? Whoa, wait. How are we at 393? What the fuck? I counted commission, but we made more money. What the fuck? We're at 393. This makes our job so much easier. That means we just gotta go fix the board, bro. We doubled it and a little more on top of that. We're at 390 today, so we had to fix the board, and now we have to fix this entire thing. Tomorrow, we have to get to $780 now. We just added $200,000 to our end goal because we made more money today. Let's get into tomorrow. What the fuck? When did we fall like that? Oh, we touched Q's? Damn, this daily is gonna be crazy. Guys, I live trade every single morning. Link in the description below. But I'll let my chat know as well. Bye. What the fuck? How did it even sell me? $32, $34, $35. Oh, that's not even that bad. That's not even that, bro. That's game. That's game. Look at that. Like, it's literally $1. Come on, bro. It's easy. We're gonna be at $800 today. So we're up like $37 right now. We're up $60, 14%. No way it's this easy, bro. No way is this easy. Like, come on, bro. And it's only $340. Like, come on, sit back, relax. Sit back, relax. So close already. Where's it going? All right, well, this was supposed to be an easy trade. Now we're stuck at break even. Did you hear that? Oh man, we're at $18. What are we gonna do? Come on. It's fucking stuck. It's over. Game over. It should have went right there. There's just so, like, since we came down so much, the only other way is up. Oh, that's bad. We gotta get through this. If we get that sell, we're gonna be up crazy because 17, 34 plus $1 on top of the contracts. Oh my gosh, we're rejecting. Oh, the red line moved. It's not good, bro. The trade that looked like it was supposed to go doesn't go. We can't go out like this, guys. Come on, just break out. Come on, bounce, bro, bounce. Look at 11s, 10s, 8s, 10s. No. Yep. Come on, just like that. Oh my, if I get another fucking wick, how long are these seconds? Oh. It's like back and forth like that. Stop falling, bro. Up. Bro, imagine this one candle just ripped. I can't go red though. Can't go red. Hold it. How long is this candle, bro? Yep. Come on, bro. Close that bitch already. No. Where the fuck are you going? Come on, new candle. Come Come on, 20s. Stop folding. Stop folding. We're at $9 on the contract, bro. Why are they cheap as fuck? Do you not realize we have to go to $35? Okay. Hold it. Keep going. Up. Stop rejecting those highs. Nope. Where are you going? Where are you going? All right, it's over, guys. Challenge is over, guys. Good video. Oh my gosh, bro. Just break out of that bitch. Break out of that bitch. Go. Oh my gosh, we're rejecting the highs. We are rejecting the highs. Stop. Where are you going? Stop doing that. Oh, nah. Where did that go? What? It's over, guys. It's actually over. We have 8 minutes left, bro, and this red line keeps running. Okay, now we're at a new low, $4 a contract. Isn't that crazy? I just get in here. What if I just got in here? Someone's gonna be in my comments like, the ICT fair value gap and the nonchalant 1 hour time frame with a weekly daily. Now it's using this as resistance? Bro, this is not in my game plan here. What are you doing? I feel like the viewers got edged. Like, I feel edged. Like, how are we gonna like fold at 400, bro? I literally can't get a challenge past 400, and if I do, it only goes to 11. I mean, we turned $5 into $400. I mean, it's still fucking crazy. I knew it was gonna happen today too. I was in a shower and I was like, watch me fold today. And there we go. If you want to learn how to trade for free, click the top link in